Have you ever noticed how when you're buying something online and you enter your address, the website just instantly flips the terminology on the screen?
Oh, yeah. Like magic.
Right? Like 1 second it says zip code.
I
The
mean,
moment you select a different country, boom, it changes to postal code.
yep. Or how a receipt you get in one part of a country can look, completely different mathematically from a receipt you get just a few hours away.
Exactly. It's wild. Welcome to the deep dive, by the way.
Thanks for having me.
Yeah.
It's one of those invisible pieces of everyday life, isn't it? You just expect digital tools to know where you are and how the local commerce rules work.
You really do.
But the underlying machinery making that happen, the logic firing off in the background is incredibly complex.
And today our mission is to decode that exact machinery. We've got a stack of sources that, well, at first glance, they might sound like incredibly dense technical reading.
Definitely dry on the surface.
Very. It's a behind-the-scenes software development manual detailing the localization of an accounting software called osFinancials.
Also known as TurboCASH.
Right, TurboCASH.
Right.
And this is specifically about adapting it for the Canadian market. And honestly, whether you are a software developer, a business owner, or just an insanely curious learner, this deep dive is going to completely change how you look at the digital forms you fill out. Or, the receipts you just toss in your bag.
Because software isn't just a random collection of code meant to do math.
Yeah.
What's truly fascinating here is how software serves as a direct reflection of a country's legal, cultural, and political DNA.
Oh, perfectly said.
Every single drop-down menu, every tax line on an invoice has to perfectly mirror the physical borders and the legal realities of the real world.
And we are looking specifically at Canada today. Right away, the development manual just entirely shatters the illusion that Canada is this one big homogenous zone for a programmer.
But it's not just Canada.
No.
No.
To make this software work legally, the developers have to map out a massive web of tax structures across 13 subnational divisions. That's 10 provinces and 3 territories, each with their own quirks.
To put that in perspective for you, think about the United States. In the U.S., sales tax can vary wildly from county to county or even city to city.
Yeah, it's super granular.
Exactly. But Canada's system is highly structured at the federal level, but deeply regional at the provincial level. The manual basically categorizes the country into 3 distinct tax groups.
3 groups, okay.
And the software has to dynamically adapt its entire underlying accounting structure based solely on which of those 3 groups a user happens to reside in.
Okay, so let's get into Group A. The manual calls this the HST provinces, which stands for Harmonized Sales Tax.
Right.
This includes places like Ontario, New Brunswick, Newfoundland and Labrador, Nova Scotia, and Prince Edward Island. And from what I read, these provinces are essentially a programmer's dream.
Oh, absolutely. And the reason it's a dream for developers is that in those specific provinces, the federal tax and the provincial tax are mashed together into one single rate.
Just one number.
It's exactly. Usually it's a flat 15%, though Ontario sits at 13%. It requires only one single tax payable account in the software's ledger. You sell a product, you apply the single rate, and the money funnels into one neat little bucket.
Though, I did catch a highly specific ticking clock built into the manual for this group.
Oh, the Nova Scotia thing.
Yes. The software has to be programmed to know exactly what day it is, because Nova Scotia's rate is legally scheduled to drop to 14% in April 2025.
Right.
If the code doesn't automatically shift gears on that exact date, every business using the software in Halifax is suddenly overcharging their customers and breaking the law.
Which really highlights the immense pressure on the developers maintaining this system.
Definitely.
But if Group A is the straightforward part, Group B is where the real programming headaches began.
The dual tax provinces.
You got it. British Columbia, Saskatchewan, Manitoba, and Quebec. In these regions, they do not harmonize with the federal government. They keep the federal 5% goods and services tax, the GST, entirely separate from their own provincial taxes.
So suddenly the software has to track 2 parallel buckets of money for every single transaction.
Yes.
And it's not just the math that changes. The manual outlines this absolute alphabet soup of acronyms that the interface has to seamlessly swap out depending on your GPS coordinates. Like in British Columbia and Saskatchewan, the software must label the provincial portion as the PST, the provincial sales tax.
But if a user crosses the border into Manitoba, the developers are mandated to change that interface label to RST for retail sales tax.
Right.
And then in Quebec, it changes again to the QST.
And there's a massive operational difference hidden in those acronyms, too. I found this nugget in the manual about how British Columbia handles its PST.
Ah, yes, the sunk cost.
Exactly. In BC, that provincial tax is generally considered an expense for a business. It is not recoverable as an input tax credit, unlike the federal GST.
We should probably break down what that actually means for the business owner using the software.
Yeah, let's do that.
An input tax credit, or ITC, is basically like a government coupon. When a business buys supplies, they pay the federal GST, but they get to claim that money back later from the government as a credit. So the software has to track that federal tax as an asset, essentially.
But with the provincial tax in British Columbia, there is no coupon. The PST is just a sunk cost. It's gone.
Exactly.
So the software cannot treat those two taxes the same way mathematically. If a business in Vancouver buys a new laptop, the software has to automatically split the receipt, log the 5% federal tax into a recoverable credit account, and then bury the 7% provincial tax directly into the company's general expense column.
The sheer complexity of that background math is staggering. Now, imagine the headache that creates for the core database.
I can't even.
You have all these wild different front-end rules and interface labels, HST, PST, RST, QST, all functioning differently depending on the region. But a software's core database needs absolute stability to function without crashing.
Right. If you've ever built even a basic spreadsheet and accidentally deleted or renamed a core reference cell, you know exactly what happens.
Everything breaks.
Everything. The formulas throw error codes, the charts go blank. Now imagine doing that across an entire country's financial system.
To prevent that countrywide crash, the manual reveals a brilliant behind-the-scenes safeguard.
The hard-coded field.
Yes. No matter what acronym is showing on the user's screen in whatever province, the core database reference field must strictly remain untouched. The field is hard-coded as FTaxAMP.
FTaxAMPs.
Exactly. If a well-meaning developer accidentally translates or alters FTaxAMP to match the local RST or QST acronym, the entire software architecture collapses.
So the software is basically wearing different outfits depending on the province, but the skeleton underneath has to stay completely rigid.
That's a great way to put it.
Which brings us to Group C, the GST-only zones. This is Alberta and the 3 territories: Yukon, Northwest Territories, and Nunavut. For these users, the software just strips away all the provincial tax logic entirely. They only charge the 5% federal GST. There is literally no provincial sales tax to calculate.
Which sounds like a relief until you factor in the final layer of the tax map.
Right.
And this applies to every single province and territory universally. The software has to account for what are called zero-rated items. There's a universal rule across Canada that certain essentials are taxed at 0%.
We're talking about basic groceries like milk, bread, and vegetables.
Yep.
Also prescription drugs, medical devices, and certain exports. The software has to be smart enough to look at a line item on an invoice, recognize it as a zero-rated essential, and instantaneously bypass all of those complex geographic tax rules we just talked about.
It really pulls back the curtain on how much invisible logic fires off the second you add an item to a digital cart.
It's crazy.
In a fraction of a second, the software checks your geography, maps it to one of the 3 tax groups, identifies the specific product category, cross-references it against the zero-rated list, and calculates recoverable versus non-recoverable expenses.
Navigating that map is wild on its own. But the most intense part of this entire localization manual, the section that truly reads like a high-stakes corporate thriller, is the Quebec anomaly.
Oh, Quebec. This is where software development stops being just about math and collides head-on with language laws and localized legal systems.
Under the Charter of the French Language, specifically Bill 96, the Office Québécois de Langue Française, or the OQLF, has very strict mandates for businesses operating in Quebec. Any accounting software interface and the actual set of books a company uses absolutely must be available in French.
To clarify that term for a moment, when the manual refers to a set of books, it means the core financial diary of a company. It's the master ledgers, the journals, every single transaction recorded in its rawest, most official form. Furthermore, Quebec operates under civil law, which is historically and structurally different from the common law system used in every other Canadian province.
Which creates a massive legal and logistical hurdle. Let's paint a picture here for you. Imagine you're the lead accountant for a bilingual corporation based in Montreal.
Okay.
You absolutely must satisfy local French auditors to remain compliant with the OQLF and provincial law, but your corporate head office and all your major investors are located in Toronto and primarily speak English.
You're caught in a massive bind. If you try to run two parallel databases, one entirely in French for the local auditors and one entirely in English for the stakeholders, you are begging for a
It's a
disaster.
total nightmare.
Trying to keep two separate ledgers perfectly synced at the end of every month is a data integrity nightmare.
You can't just hope the numbers match up. But the manual details this incredibly elegant workaround using a tool they call the Multi-Language Accounts plugin. It allows the software to maintain one single unified legal database, but it actively maps dual language terminologies over top of that data based on who is sitting in front of the screen.
It functions like a real-time translation layer over a static database. The underlying math and the core entries never change, but the terms used to describe them shift instantly.
The examples they give in the manual show how nuanced this has to be. If the system logs a transaction, the French interface tells it compte clients, but it automatically maps to accounts receivable on the English side.
Right.
Some words just work perfectly in both languages, like the word stock, but they actively have to avoid certain English words to make the translation work legally in Quebec. For example, the developers are warned not to use the English word vendor.
And there's a very specific linguistic reason for that. If you translate vendor literally into French, you get vendeur. But in Quebec's civil law and accounting terminology, a vendeur implies a retail clerk or a salesperson on a shop floor.
Ah, not a supplier.
Exactly. It does not mean a corporate entity providing goods. To fix this, the software mandates the use of the English word supplier because it neatly and legally maps to the French accounting term fournisseur.
The practical application of this translation layer is something the manual calls audit mode versus management mode. Let's go back to our stressed-out accountant in Montreal. An auditor from the OQLF, or Revenue Quebec, walks through the front door and asks to see the books.
High-stress moment.
For sure. The accountant calmly clicks a button, and the user profile is set to French. This is audit mode. The auditor looks at the screen and sees a fully compliant, civil law-structured, French-language financial diary.
Then, an hour later, the auditor leaves. A stakeholder logs in remotely from Toronto. They switch their user profile to the English master file, which the manual labels NCAQC. They're looking at the exact same financial data, the exact same core ledger entries, but translated perfectly into English management terms.
It extends all the way down to the customer level, too. The software dynamically adjusts the actual printed documents leaving the building. If the business generates a bill for a local customer in Montreal, the layout file automatically prints a document titled Facture in French.
Right.
But if they generate a bill from that exact same system for a customer in Toronto, it prints an invoice in English.
Yet both documents, regardless of the language or the title, will pull from the same FTaxAMP database field and display the exact same corporate tax registration numbers.
It's brilliant.
It's a digital shapeshifter. It changes its language and its legal terminology based entirely on the audience, while fiercely protecting the core math underneath.
And when software is built with this level of deep cultural integration, you don't even notice it. It just feels natural. But when software lacks that localization, it is immediately obvious.
Oh, painfully obvious.
The manual actually features an entire section on the secret language of accounting, outlining the immediate tells of a poorly adapted program, the single biggest dead giveaway. If a piece of software asks a Canadian user for their zip code,
the manual is incredibly strict about this specific data field. It mandates a universal, sweeping change from zip code to postal code across all 13 Canadian regional files. If a user in Calgary or Halifax is prompted for a zip code, they instantly know they are using a generic American product that hasn't bothered to adapt to their country.
It instantly shatters the illusion. The developers also have to run a massive system-wide spelling check. The manual insists on British-style spellings for the Canadian market. They have to code in words ending in OR like labor or RE like center.
Right.
It might seem like a trivial aesthetic choice, but it is fundamentally about building trust. If your accounting software feels foreign or uses the wrong vernacular, you are not going to trust it to handle your local tax filings accurately.
That concept of trust extends to the very specific terminology used to describe the people you do business with. The source documents strictly enforce the use of the terms supplier and customer for the entire Canadian market. They explicitly forbid developers from using terms like creditor or vendor or debtor in the interface.
Wow, even deader.
Even debtor. Even if a trained accountant technically understands what a debtor is,
Yeah.
using that word violates the localized standard the software is striving for.
There is another major myth the manual busts regarding localization, and that is the concept of the tax invoice. This is a huge adaptation, particularly for places like Alberta. In accounting software built for the UK or Australia, it's actually a legal requirement to boldly print the words tax invoice at the very top of a receipt.
Right.
But in Canada, doing that makes the software look completely alien to the user.
Businesses in Canada simply issue an invoice. As long as their federal GST number or business number is printed somewhere on that document, it is considered a legally binding tax record. The manual literally commands the programming team to strip the word tax out of the invoice headers for all the Canadian files.
Because good localization is entirely about removing friction. You shouldn't have to mentally translate the software's interface into your local reality. The software should just exist in your reality natively.
Exactly.
And this goes way beyond just swapping out a few words on a screen or changing the spelling of center. It goes deep into the actual accounting frameworks that dictate how a business measures its own financial health.
This is a critical distinction. Canada does not use US GAAP, which stands for Generally Accepted Accounting Principles. That is the framework that dictates American finance.
Right.
If you try to apply US GAAP to a Canadian business, the categories will not align legally. The software has to completely adapt its entire chart of accounts based on what type of corporate entity is logging in.
The manual outlines 3 distinct frameworks that the developers have to build parallel tracks for. The first is IFRS, the International Financial Reporting Standards. This is a massive, complex framework meant for public companies, entities that are actively trading on the stock exchange.
If the software is set to IFRS mode, it has to utilize very specific corporate terminology. It uses the word depreciation to track the loss of value on physical items, and it must include highly specific equity accounts for shareholders, like other comprehensive income or OCI.
But the vast majority of businesses using the software are not publicly traded on the stock exchange. If the business is a private company, they use a completely different framework called ASPE, the Accounting Standards for Private Enterprises.
Yes.
The moment you select ASPE, the software has to dynamically swap the terminology out again. It can no longer use the word depreciation. It legally has to use the word amortization. And it swaps out complex IFRS terms like property, plant, and equipment for the much simpler phrase, capital assets.
And finally, if the user setting up the software is a charity or a not-for-profit organization, they use a third framework called ASNPO. The software has to entirely restructure the ledgers to utilize what is called fund accounting. It separates money into distinct categories like general funds, restricted funds, and capital funds.
Which raises the question, why does a local charity need a completely different set of terms from a private hardware store?
It ultimately comes down to how these different entities define and measure success. A public corporation using IFRS is intensely focused on tracking how its assets lose value over time to report to shareholders, hence the focus on depreciation.
Makes sense.
But a charity using ASNPO is not primarily focused on asset value or profit margins. Their legal mandate is tracking exactly where donated money goes and proving it was spent on its intended purpose. Fund accounting allows them to do that, and the software has to provide the exact framework necessary to prove it to the government.
It is absolutely wild to think about the sheer volume of logic happening in the background. You download a program, you click private company in British Columbia, and thousands of lines of code are quietly shifting into place.
It's staggering.
It changes terms from vendor to supplier, swaps depreciation to amortization, separates out a 5% federal GST and a 7% provincial PST, ensures that provincial tax isn't accidentally calculated as an input tax credit, checks that your postal code is formatted with letters and numbers instead of just zip code, and makes absolutely sure the word tax doesn't appear in front of the word invoice.
And it is executing all of those complex, geographically specific maneuvers while ensuring that the F-tax amped variable deep in the core database never ever changes.
What looks like a simple, clean digital invoice or a basic software drop-down menu is actually the end result of navigating federal tax laws, highly specific provincial quirks, strict language mandates, and tiered accounting frameworks. It is a masterclass in hidden complexity.
Localization really is an art form disguised as data entry.
So the next time you are checking out online or you grab a coffee and get a receipt from a local business, Take a second to look closely at the terminology. Look at how the tax lines are split. Look at whether it asks you for a postal code or a zip code. You now have the tools to reverse engineer exactly how that software was programmed to handle your specific location on the map.
Which leaves us with a rather profound question about the future of technology. We have just spent this entire deep dive looking at the incredible, almost invisible effort that goes into localizing software to reflect physical borders and local laws.
Yeah.
But as business becomes increasingly borderless and globalized, something eventually has to give. Will our software continue to become infinitely more complex, constantly adapting to every hyperlocal quirk, language law, and shifting provincial tax rate? Or will the sheer exhausting friction of programming this technology eventually force governments to standardize and simplify their own rules just to keep up with the digital age?
Now that is something to think about. Until next time.